As GDP shrinks, it is not clear where the economic jumpstart will come from. The slowdown should remove any lingering doubts that the Bank of England will agree an interest rate cut when it meets next week. The expected quarter-point trim taking the headline figure below 4% for the first time since January 2023. The British economy has been slowing since the summer, but the long wait for a late November budget applied an extra touch to the brakes, according to the latest growth figures from the Office for National Statistics. A monthly contraction in GDP of 0.1% in October, and a similar fall in the three-month trend, was attributed to uncertainty about Rachel Reeves's plans amid an autumn blizzard of trails, leaks, and speculation. The ONS said businesses across the production, construction, and services reported waiting for the outcome of the budget. It was not the only factor. Output was pulled down by the continued impact of the Jaguar Land Rover cyber shutdown, and services, the engine of the economy, were flat. But we can now put a price on the Chancellor's prevarication. It is likely to have taken a toll on November's figures, too, making it likely that the year will end with a quarter of stalled growth, and raising questions about where a rebound may come from. The slowdown should remove any lingering doubts that the Bank of England will agree an interest rate cut when it meets next week. The expected quarter-point trim taking the headline figure below 4% for the first time since January 2023. The pace of cuts beyond that remains uncertain, but if the torpid performance continues, then another cut could come as early as February. The bank and the Office for Budget Responsibility both expect inflation to decline in 2026, too, which could help the economy climb out of the current slough. In a statement, the Treasury said the government was determined to defy forecasts and cited a number of projects as examples of its pro-growth credentials, including new runways at Heathrow and Gatwick and the Sizewell C nuclear power station. What they all have in common are completion dates in the next decade, and with the budget scored as having no immediate pro-growth measures and tax rises to come, it is not clear where the economic jumpstart will come from. If you are a mother juggling the demands of raising a family while trading commodities for a hedge fund, and you also happen to be hacked off with your employer, then 2026 could turn into a very good year. The Employment Rights Bill currently making its way through Parliament is about to award you lots of extra rights. There is just one catch. It will also make firms very reluctant to hire anyone, crushing the economy at a moment when it is already stagnating. The bill, being driven through by Junior Minister Kate Dearden, is likely to turn into one of the most significant reforms of a Labour government that, in most respects, has done very little apart from putting up taxes to spend more on welfare. We already had a good idea that it was likely to be very damaging. But, as the small print has started to emerge as it makes its way through Parliament, it is turning out to be far worse than anyone had feared. Take salary caps, for example. Right now, the law limits the amount a tribunal can award to £118,223, or 1 year's salary. After negotiations with unions, that will now be scrapped, allowing potentially unlimited claims against firms. It is not hard to see how that is going to end up. A star trader in the city, or an exceptionally well-paid CEO, might be making £1 million or more a year, and they will now be able to sue for several times that amount if they feel they have been discriminated against or unfairly dismissed. It will create huge incentives to game the system, simply because anyone on those kinds of earnings will be able to hire the best lawyers to make a claim, and might well make themselves several million by doing so. The cap was designed to ensure the tribunal system was mainly there to protect low-paid workers from exploitation, but now it will be used just as frequently to secure vast payouts for the highest paid. Or take working mothers. The bill will make it impossible to dismiss women who are pregnant, on maternity leave, or for 6 months after they return to work. Persistent lateness, poor performance, or a bad attitude won't count, and even a conflict of interest, such as shares in a rival company, might in some cases not be enough. In effect, they will become almost a specially protected class, against whom very limited action can be taken. Given that there are around 6 million working mothers in the UK, that is no joke. And this comes on top of all the extra rights that were already in the first draft of the legislation. Employees will have the automatic right to ask for flexible working from day one, instead of in exceptional circumstances, and if courts beef up that right, as they almost certainly will, then it will essentially be up to staff to decide when and where to work. 0 hours contracts will face lots of fresh restrictions. Statutory sick pay will be available from the first day someone reports as feeling unwell. Parental leave will be mandatory from day one in a new job instead of kicking in after an agreed term. Anyone with more than 250 staff will have to produce an annual gender equality plan. The list goes on and on. Impact of the Employment Rights Bill. That is going to be a disaster for the labor market. Staff should, of course, be well treated and protected, but that is best achieved through a strong economy that generates lots of jobs, so that people can pick and choose whom they work for, instead of smothering the market in so much red tape that no one wants to employ anyone in the first place. The tribunal system is already clogged up, with the latest Ministry of Justice figures showing the number of claims in the pipeline has reached an all-time high of more than 500,000. An extra 330 pages of legislation is only going to add to that number. Only this week, the unemployment rate rose to 5.1%, its highest level in 5 years, and millions more people have effectively withdrawn from the labor market and are living on sickness benefits instead. The number of job vacancies fell for the second month in a row in November and has now reached its lowest level since 2025. For new graduates, the market has rarely been so weak. With the rise in national insurance, it was already a lot more expensive to hire in the UK. Soon, it will be impossible to get rid of them if they don't work out. Once the bill becomes law, expect a full-scale collapse in hiring. Very soon, it will not be financially viable to employ anyone in the UK. Many of the UK's key economic indicators are poor. The economy is not in recession. Markets are still buoyant. Tariff impact yet to be properly accounted for. Chancellor Rachel Reeves said the UK's latest gross domestic product (GDP) figures earlier this month were disappointing. The Office for National Statistics, ONS, said that there was a 0.1% contraction in economic activity in May, the second fall in as many months. Is that news really cause for alarm? A technical recession is defined as 2 successive quarters of negative economic growth. If those negative monthly figures turn into negative quarterly figures, the UK will be in recession. The last time that occurred was in the final quarter of 2023. To say the UK is on the brink of a recession is probably a stretch, but the economy is certainly far from robust. Michael Field, Chief European Market Strategist. These are not the only economic indicators concerning investors, however. Inflation remains sticky at 3.6%. way above the Bank of England's 2% target. Latest government borrowing figures for June also show the UK borrowed £20.7 billion last month, up from £6.6 billion in June 2024. Borrowing in the current financial year is currently estimated to be £17.2 billion more than in the 2024/2025 financial year, and £11.0 billion more than the £137.3 billion forecast by the Office for Budget Responsibility, OBR, in March 2025. This limits the fiscal headroom that allows the government to spend on projects designed to boost growth. Government borrowing costs remain at elevated levels. The 10-year gilt yield is 4.63%, nearly 50 basis points higher than a year ago. Economists use a long list of indicators to assess the health of the UK economy. There are varying time delays in the public seeing this data. For example, the latest unemployment figures run up to May, but we already have the June inflation data. Some indicators are described lagging or backward-looking, like inflation and the unemployment rate. These are limited in their ability to show what may happen next. Others are leading or forward-looking, like consumer confidence indexes, new unemployment claims, and stock market prices. Meanwhile, GDP data is considered a coincident indicator in that it reflects the current state of the economy. Here are some key indicators economists use. GDP. 2 successive quarters of negative economic growth are considered a recession. Long-term economic growth rates have weakened over time in the UK, spurred by shocks like the global financial crisis, Brexit, and the COVID pandemic. Consumer spending/retail sales. Shoppers tend to tighten their belts in response to economic uncertainty, which can lead to lower economic output. Monetary policy works on the idea that raising rates, and therefore making debt more expensive, is one way of cooling consumer activity in the real economy, thus slowing price rises. This keeps a lid on inflation, but makes borrowing more expensive, so can hamper economic growth in a credit-driven economy like in the UK. Employment. Recessions tend to stifle wage increases and promotions and slow down job mobility. But economic uncertainty can trigger redundancy programs by employers anyway, even ahead of an actual recession. Rising unemployment or declining job growth indicates problems in the economy. Often companies then begin hiring again when the economy picks up. Inflation. Prices tend to rise during periods of economic growth, and the opposite is usually true during contractionary periods. But persistent high inflation without corresponding economic growth may cause consumers to cut back on spending. If this situation persists, it can turn into stagflation. For example, the UK has faced higher energy and food costs since 2022 in a subdued period of the UK economy. Interest rates. Higher inflation typically means the Bank of England will raise rates to contain the speed of price increases. Likewise, it may lower rates to encourage spending and borrowing, at the risk of more inflation. Stock market performance. The stock market and the economy don't always move in tandem. Economic uncertainty or external shocks like tariffs can certainly prompt market sell-offs, however. The prices of stocks deemed vulnerable to falling consumer spending can likewise fall, while more recession-proof or defensive stocks tend to prosper. UK GDP looks weak, but recession isn't here yet. GDP measures the economic output of a country during a specific period and is reported usually monthly, quarterly, and annually. For example, the UK has only recently started reporting monthly GDP figures, while the markets still focus on quarterly data. In the UK, economists and commentators have long cited relatively low GDP growth as evidence of the economy failing to fire on all cylinders. Recently, that malaise has prompted a host of regulatory, pension, and ISA reforms to drive investment and activity in the economy. While the UK's GDP figures have been disappointing, a recession still looks distant. GDP growth was positive to the tune of 0.7% in the first quarter, and expectations for the second quarter point to a number anywhere between 0 and 0.5%. It's still not clear what is the precise effect of the U.S. tariffs on the UK economy. The UK has a preferential trade deal with the U.S., but the longer-term effects are yet to be seen. UK consumer spending is slowing. Economists look at consumer spending as a measure of economic activity in the UK, especially given the economy's dependence on services. Hotels, holidays, bars, restaurants, and even concerts generate billions. But these are cyclical sectors that depend on a feel-good factor. Rising house prices, cheap credit, or strong pay growth can bolster this. In June 2025, UK consumer spending slowed when compared with the previous month. In addition, the ONS says that, in June, transport indicators showed reduced activity, with the number of UK flights and the number of ship visits to major UK ports falling by 1% compared to May. Manufacturing and construction activity have been on the decline for at least the last 6 months, but services activity, which constitutes a far larger share of employment, has seen growth for all but one of the last 12 months, says Field. UK jobs market shows signs of weakening as taxes rise. Several measures show what is going on in the UK labour market, including pay growth, unemployment numbers and rates, and companies announcing restructuring or redundancies. A key context is a government increase to employer national insurance contributions in April 2025, which some businesses are struggling to afford. They have cut back hiring as a result. Some are laying off workers. According to the ONS, the number of total employees in the UK fell by 0.4% between May 2024 and May 2025, meaning 135,000 fewer people in work. In the period March to May 2025, payrolled employees fell by 81,000, a 0.3% dip. The early estimate for payrolled employees in June 2025 shows a decrease of 178,000, or 0.6% on the year, and by 41,000 on the month, to 30.3 million. In the period March to May 2025, the unemployment rate for people aged 16 and over was 4.7%. This is above estimates of a year ago and up in the latest quarter, the ONS said. The UK claimant count, which tracks the number of workers claiming unemployment benefits, increased on the month and the year to 1.743 million in June 2025. The number of potential redundancies increased by 17% compared with the previous month. More than 13% of young men are considered NEETs by the ONS, which people between the ages of 16 and 24 not in education, employment, or training in the UK. The number of employers proposing redundancies increased by 2%. This is determined using data from the UK Insolvency Service. UK inflation is sticky but should still fall. Rising fuel and fuel costs have been driving UK inflation higher in recent months. In its latest data, for June, released earlier this month, the ONS said the Consumer Prices Index accelerated by 3.6% in the 12 months to June 2025, from 3.4% in the same period for May. It had been expected to remain at 3.4%. This creates something of a problem for Bank of England, which has been battling inflation and falling economic growth amid U.S. tariffs. For its part, the Bank of England has said it expects inflation to rise to 3.75% through 2025, before falling to 2.4% in quarter 2 2026, and 1.9% in Q2 2027. Recall that CPI was rising by more than 10% in 2022, before falling back to 2%. Investors still expect a Bank of England interest rate cut in August. Cutting, holding, or increasing interest rates allows central banks to influence the flow of money into the real economy. Investors still expect a rate cut when the Bank of England's Monetary Policy Committee, or MPC, meets next month. Homeowners and house builders are all waiting for rates to fall so mortgages become cheaper and house buying becomes easier. But the era of ultra-low interest rates is gone for good. While the Bank of England is not at the end of its rate-cutting cycle, market prices suggest the neutral or terminal rate is expected to be around 3%. This is far higher than interest rates in recent years. Rates hit a record low of 0.1% just after the pandemic. That comes as the average UK house price shows the most significant fall in more than 2 decades, following on from changes to stamp duty in April, where a temporary discount ended. According to property website Rightmove, the average price of a home for sale in July fell by £4,531, or 1.2% when compared to June. The average price of a house in the UK is now £373,709. The company also said the number of properties for sale is at a decade high. This indicates demand has weakened, and the UK housing market has slowed. But the UK stock market is at a record high again. The stock market cannot always be used as a bellwether for the economy, but its performance does tell onlookers a lot about economic confidence. The UK FTSE 100 index is at all-time highs. Having initially repeatedly flirted with the 9,000 points mark, it closed above that level on July 21st and on subsequent days. This might seem incongruous given falling GDP, but several factors explain it. Less than 20% of revenues of these companies originate in the UK, so in effect, these companies are feeding off European and global optimism, Morningstar's Field says. The FTSE 250 is probably a better proxy, which is trading at 3-year highs, but still below 2021 levels. Despite all the overhangs with tariffs, a slowdown in growth for the Magnificent Seven, and generally anemic growth, U.S. and European indices are also trading at all-time highs. This is slightly less of a concern in Europe, where we still see marginal upside. But in the U.S., markets are swiftly moving into overvalued territory. Unlike much economic data, stock markets are considered leading indicators in that equity prices reflect expectations about future growth, both at a corporate level and in the wider economy.